Zero tax on a profit of 1.35 crores? Yes, this actually happened. A woman living in Singapore sold her Indian mutual funds and made a whooping profit of 1.35 crores and legally paid zero taxes. The tax department, however, sent her a notice and the case went on to the court. The final verdict of the court is what every NRI should understand. In this video, I'll walk you through her case and how she paid zero taxes. How the tax department said that she needs to pay taxes, whereas the court said no, she doesn't. I'll even tell you what things need to be done the right way to pay zero taxes, because one small mistake can lead this zero tax case into a long legal mess. Now let's start from the beginning. This woman lives in Singapore. She works there and she earns there and pays her taxes regularly over there. For tax purposes, Singapore is her home. But for investment, she invests in Indian mutual funds. And after a point of time, she sells them for a profit of 1.35 crores, but doesn't pay taxes in India. But one day, tax department serves her a notice and she gets a tax notice to pay taxes in India. From the tax department's point of view, the logic was simple. The investment was made in Indian mutual funds, so the money came from India. So the taxes need to be paid in India. That is logical, right? But here is where an important rule comes into picture. That rule is DTAA. Think of DTAA as a rule book of taxes between two countries, wherein India and Singapore agreed on rules about whom to tax what. So if the money is connected to both the countries, DTAA decides who collects the tax. So after getting the notice, she didn't panic. She first went to something called as DRP. Think of DRP as the first level where taxpayers argue with the tax department, where she explained her case, but the department didn't agree to it. Most of the people stop here, but she didn't. She then approached ITAT. Think of ITAT as the tax court, a court where tax experts sit and decide the disputes between the taxpayers and the tax department. And here is where her case was properly examined. Here's where things turned. She focused on one key note, that company shares are different from mutual funds. This might sound very small, but this small thing changes the tax rule completely. Because of Article 13 of India-Singapore DTAA, shares fall into one category, whereas mutual fund fall into a completely different set of category. And this set of category mentions that the taxes need to be paid in the country where she lives. And she lives in Singapore, so taxes need to be paid in Singapore. Thus, no taxes or capital gains need to be paid in India. The tax code agreed with this and said that treaty benefits cannot be denied just because the investments are in India. Mutual funds fall under the other investment category and thus need to be taxed in the country where the person lives. She lived in Singapore, so she'll be taxed in Singapore, and India cannot tax these gains. Thus, this demand was completely cancelled. So the final result was India zero tax, Singapore zero tax, because Singapore doesn't levy any taxes on capital gains out of these investments. So end result, zero taxes paid by the individual. Now the most important thing, this would only work if she was actually an NRI, she had proof of living in Singapore, and the treaty would allow these benefits, and lastly all the paperwork is perfectly fine. Even a miss of any one of these, then the story would be completely different. The lesson is simple. Just because the money is coming from India, that doesn't mean India can tax it. This is where DTAA comes into picture. Save this video now and send this to your friend who stays abroad, because understanding the rule early is far cheaper than fixing it later.